Hi, I'm Brett Cenkus. I'm a business attorney with a focus on M&A or mergers and acquisitions and M&A advisor. Today, we are not talking M&A. We are talking 83B elections, which generally come up kind of in the startup context, and whether or not, what are they and should you file one? So to understand 83B elections, it's very important to understand two fundamental concepts. The first is when a company gives out, and this is usually where this comes up, compensation or incentive equity, right? So it gives founders some stock or gives someone who they hire some stock when they hand out equity. It could be an LLC interest, it could be a share of a corporation, but it's some sort of piece of ownership. When they do that, it's viewed as compensation, and you're taxed on the difference when you receive it of what it's worth and what you pay. Okay. So that's the first thing, is that any delta between what this stock, let's just talk about stock rather than LLC and partnership interests and things. If you receive shares of stock, you have to pay the difference. You have to recognize as ordinary income. That's the better way to say it. You recognize ordinary income between what the stock is worth and what you pay. That's the first thing. The second concept to understand is that the IRS does not view you as owning shares of stock if they are subject to substantial risk of forfeiture. Okay, that's the term. What does it mean? It means you may not really keep these shares. And where does that come up most commonly in the context we're talking about? It comes up if the shares are vesting. So vesting is a concept that says these shares, you don't really own these shares. And that's why the IRS says they're subject to substantial risk of forfeiture. Vesting says you don't really own them until something happens. So there's time-based vesting, which says after a certain amount of time, you'll own shares. And a lot of times that it looks like for 1 year, like sometimes startups will grant equity to employees and it will be a 4-year vest with a 1-year cliff. And what that means is nothing vests for a year. So if the company lets you go or you walk away in the first year, none of your shares are vested. They all go back to the company. And then on the anniversary of the first year, a quarter of them vest. And so if you walk away, you keep those shares. That's time-based vesting. Performance-based vesting is if you hit certain milestones, these shares will vest. And again, vest means now you really own them. That's what that means. And so while shares are vesting, they are, according to the IRS, subject to substantial risk of forfeiture. I mean, almost always. It's law, so there's always some exceptions in the IRS's eye, in the law's eyes. But generally speaking, and so what that means is if I hand you 100 shares today and you don't pay anything for these shares and they're worth $1, you've received compensation of $100 if there's no vesting. That's what you've received today, right? If I say, hey, half of these shares will vest in a year and the other half will vest in 2 years, then today you've received nothing. In year one, you've received whatever the difference is. You paid nothing. So now what are these shares worth? Let's say they're worth $2. Now you've got $200 of compensation in year one when these shares vest. And then remember, in the second year when the rest of them vest, let's say the stock's worth $10. Now you have $1,000 of compensation. So the point I'm making here is as the shares vest, if the stock's going up and you're not paying much for it, the delta between what it's worth and what you're paying is getting higher and higher and higher, you're having to recognize more and more income as the recipient of the stock, which, generally is not a great thing to most people. So anyway, those are the two concepts you need to understand. So now a lot of times when we're talking 83B elections, we're handing stock to founders and they're not paying much for it, but it's not worth much. Okay, so we're saying, look, that you're paying par value, which is this old antiquated concept of the minimum amount of money you have to pay for a share of stock. And sometimes it's like 0.0001, a hundredth of a penny. It's nothing. And so, but we're saying it's really not worth any more than that. Okay, but there's vesting. And so these shares are going to vest over time. And the shares may be worth a lot more tomorrow, in a year, in 2 or 4 years. And so the problem that sets up is the founder doesn't know if they're going to pay zero, what kind of tax they're going to have to recognize yet. And it's going to be in monthly vesting every month, they're recognizing some gain, some income, because again, they're paying nothing and the shares are worth something, increasingly more in our example. And so every month they're having to figure out, what is this stock worth? I paid nothing. What's it worth? And ultimately, when they file their tax return, claim that all as income. So you see the problem with a company who just sets up with the founders, and the founders are going to set up vesting, which they should, because if they're gonna go ask for venture capital money, the venture capitalists are gonna usually require it. So these founders are thinking, well, how do I know? I mean, it'd be great if it could all be taxed today, because although I'm paying nothing, it's worth nothing, right? And I don't know tomorrow as it vests what's going to happen. And so the 83B election, it's as close to a free lunch as you're ever going to find in the world, is the IRS's sort of acknowledged solution and tool that you can use to get around the problem that comes with unknown fair market value increases of these shares and many, many vesting events that you can follow an 83B election, which what it does is accelerates all the taxation. It's as though from the IRS's perspective, there is no vesting. You are, even though there's substantial risk of forfeiture for the unvested shares, the IRS views it as, we'll ignore that and we'll tax you entirely on all the shares you get right now. And if what you're paying is the same as what they're worth, which again, in my example of the founders where they haven't done anything really yet. The shares are pretty clearly worth nothing. They're worth whatever the founder's paying into the bank account for the shares, whatever the purchase price is, and it could be exceedingly low. Then the move is to file an 83B election because there is no tax owed, because there's no delta and there's no difference between what they pay and what it's worth. And you don't have to worry about the stock going up in value next month, next year, 4 years from now. And so that 83B election accelerates the taxable event, so it happens today and not as the shares vest. And that makes a lot of sense to do that where there's not going to be any tax owed today. And so that's generally what we're doing with founders when we're sending things up. You have 30 days from the date you receive the stock, the date of grant, to file the 83B election, or you can never do it. Okay, I mean, it's very important. That deadline is you're not going to get the IRS to say, oh, sorry. And you got to send that into where you send in your 1040s every year. And you want a record of it, some certified mail or something that you did it. And you should give a copy of it to the company. Usually they'll ask and require that you do to make sure that you did it. It's the move when companies are young. I mean, almost always you're going to do this. If there's no delta between what the shares are worth and what you're paying, you're definitely going to do it. Even if there is a small delta and you got to pay some tax, you got to look at it and think, you might pay tax. These shares might be worth nothing tomorrow. That's never a good thing. But what is the risk of what they'll be worth tomorrow? So you got to make that decision. So that's the 101 with what are 83B elections and should you file one? If you've got a general question, you can drop in the comments. If you have a specific question, please reach out. You can get a paid call with me, usually same day at clarity.fm/Brett Cenkus. I appreciate you watching this video today. Thank you.